Hi, I'm Linda Eedes, and thank you to everyone who's joined us for today's webinar. I'm joined today by my two colleagues, Rashaad Tayob and Farzana Bayat. They are both fixed income portfolio managers here at Foord, and Rashaad is also a macroeconomic strategist, so we're going to be talking about both of those topics. The title for today's webinar is SA Bonds at 10% Yields. Are they a no-brainer or a money trap? And just a reminder that Farzana and Rashaad manage our three Foord fixed income funds. We launched three specialist fixed income funds towards the end of last year. That's the Foord Income Fund, the Foord Flex Income Fund, and the Foord Bond Fund. And we've had a really good start with those funds. They're all delivering alpha already over a very short period of time. And we've managed to raise almost 2 billion rands in those funds. So please do talk to your relationship manager about how to access those funds. So turning now to today's topic, South African nominal government bonds trading at more than 10% yields. We're going to be discussing whether that is the opportunity that many think it is, or perhaps outlining some of the risks involved, and then concluding with how we positioned within our funds as a result. So with that, I'll turn over to you, Rashaad.
Thank you, Linda. Now, we all know that South African bond yields are elevated at the moment, and everyone seems to hold a lot more of them than they used to. So if you look at banks, pension funds, balanced and income funds, they've been enticed by these high yields, and you find that allocations over the last few years have increased materially. Now, historically, when you've bought at these yields, it's proved to be a good opportunity. So if we look at the historical context, some background, in 2001, we implemented inflation targeting in South Africa, and in 2004, bond yields fell below 10% for the first time. And since that point, we've seen three instances where bond yields went above 10%, and it was only during severe crises. So the financial crisis of 2008, Nenegate in 2015, and then the COVID crash of 2020. And in each of these three instances, bond yields reverted quite quickly, and it proved to be a very good buying opportunity for bonds. Now, bond yields went above 10% again last year, but this time they haven't actually reverted. In fact, they seem to have gotten a bit stuck. So the question is, at this point, are bond yields at these 10% plus levels a good opportunity, a no-brainer, or are they a potential money trap? Now, this is very pertinent for us because, as Linda mentioned, we have launched two new income funds, the Foord Income Fund and the Flex Income Fund. And the objective there is to deliver yield, to protect capital, and to beat inflation. And we know that bonds at these levels can deliver yield and generate good yield, but do they protect capital and do they beat inflation? And as we go through this presentation, I think you'll get a good idea of where we see value in bonds or not, and how we intend to use them in our income funds going forward. So let's start with some context on why the majority of the market is seeing bonds as very attractive at these levels. As I mentioned, when you buy bonds at a high level of yields, you generally get a good returns. And the relationship that people generally look at is the entry yield versus the subsequent return. So what the chart I have here, on the x-axis, it shows the level at which you buy the bonds, and the y-axis gives you the subsequent 3-year annualized real return. And you can see from this that if you buy bonds at the 10% level, historically, that has generated a real return of 6 to 12%, which is an excellent return for this type of asset class. So it's no surprise that the consensus is that is very positive on bonds at the moment. However, what I'd like to highlight is that this chart, which shows a very good upward sloping relationship, is built from the post-2000 data. And that was an environment of, as I mentioned, inflation targeting, generally lower inflation, and also lower debt, i.e. very good fundamentals in terms of the South African economy. If you look at history and you break it down into the post-2000, if you look at the post-2000 period and compare that to pre-2000, the post-2000 period, inflation averaged 5.5% and our debt levels were quite reasonable. Pre-2000, inflation averaged above 9%, and we had a much higher debt level. So when you're trying to ascertain whether on a forward-looking approach bonds are a good investment, it's good to think about what type of environment we're going into, which type of environment is relevant for the future period. Is it the low debt, low inflation environment that we've had for the last 20 years, or maybe the pre-2000 period? And when we look at that same analysis using data from pre-2000, it's the same x-axis with initial yield versus subsequent real return. You'll find that when you buy bonds at 10%, when you bought bonds at 10% in that environment, the subsequent real return ranged from minus 12% to 3%. Nowhere near as good as what you saw in the post-2000 period, because it was an environment which wasn't necessarily conducive to good returns on bonds. It was an environment of high debt and high inflation. So let's look at what type of, and try and understand what type of environment we will have going forward. And the first thing to note is that SA has a debt problem. If you look at the total debt outstanding in South Africa, this is the history since 2006. We crossed R1 trillion of debt for the first time in 2011, and we ended last year, 2022, at 4.7 trillion rands worth of debt. That is a phenomenal growth in a very short space of time. If we've just followed the trajectory of inflation, we should only have debt of about 1.5 trillion, but we've effectively got 3 times that amount. Our debt has increased quite dramatically in recent years. And on a debt to GDP basis, which is the metric that everyone looks at, we were in a phenomenally good position with close to 25% debt to GDP in 2007, and that's over 70% now. And in fact, it would have been worse if we hadn't rebased our GDP, our nominal GDP upwards, which brought down our debt to GDP. So we did that in 2021. And we've also had elevated inflation over the last 2 years, which has also improved our debt to GDP ratio. If it wasn't for that, we'd still be sitting with an 80% plus debt to GDP ratio. Now, why have we had this increase in debt? It's because we've just been running persistent budget deficits. So since the financial crisis, our budget deficit has varied between 4 to 5%. It blew out to 10% during the COVID period and is now still above 4% and likely to be 5% going forward. And if you look at the fundamentals in terms of management with the economy, an example we can take is the municipalities, and the number that are in financial distress has gone up from 66 all the way to 169. So out of the 250 municipalities in South Africa, 169 are in financial distress. The majority are in financial distress, which gives you an idea of the level of governance deterioration that we've seen in South Africa. The SOEs are a big problem across the board. Eskom recently got a 250 billion rand bailout. This chart shows the debt repayments that are due to SOEs in the coming years. And besides Eskom, you've also got Transnet, Land Bank, which are also going to be a big drain on the government's resources in the coming years. Now, what's the most disappointing thing about this debt buildup is while we have spent all this money, we haven't actually been able to generate economic growth out of it. So over the last 10 years, our average economic growth has only been 1%, which for an emerging market economy is quite pathetic. If you look at the projections from the SARB for the next year, they're only projecting a 0.5% economic growth because of the electricity constraints that we're facing. So in an environment where you're spending a lot of money and you don't have any growth to show for it, it's not surprising that your debt is continuing to spiral out of control. These are the recent budget projections that we saw in the February budget. You can see that our debt is projected to go up to about 73%, flatten out, and then come down again. Post the February budget, we saw that wage settlements were around the 8% level. So if you look at that line item, the wage bill was supposed to be at 630 billion. It's likely to be 700 billion. So that will immediately cause that debt trajectory to increase in the shorter term. But on the right-hand side, what I've got there is a chart I've pulled up from a few years ago, which shows the debt trajectory that the Treasury has showed historically for 2017, 18, 19. And they've consistently showed a picture where debt increases, flattens out, and then comes down. But in reality, it never flattened out, and it definitely didn't come down. And we just saw a continued increase in debt over that period. And I think I think that historical debt increase is likely to continue in coming years. Now, given the high debt levels, it does put us in a very fragile position. And you can see that when we are in this fragile position, when we do get a negative economic shock, what happens is our debt can spiral out of control quite quickly, and that happened during COVID. So our debt to GDP was 80%, and we found that we were heading towards the 90% level quite quickly. Now, if we do see an economic shock in South Africa, maybe driven by a US recession or something in China, we'll find that our debt will escalate quite quickly. So while we do have some semblance of control at the moment, we are vulnerable to negative economic shocks. This graph shows the cost of the debt that we've accumulated over all these years. It's the debt service cost. How much of our revenue are we spending on the debt servicing? And you can see that's increased from below 10% about 10 years ago. It's now sitting very close to the 20% level. So the amount we're spending on debt servicing, just interest payments, is very similar to how much we're spending on essential services like health and education. That is a very bad situation that the country is in, and it shows you the cost of the reckless spending that we've had over the last decade. And while we've spent all this money, it does look like the economic fundamentals have deteriorated. This shows you a picture of the Castle of Good Hope. I drive past this tourist attraction on the road to work every day. And in 2007, this was nice and clean, a very popular tourist destination. You could walk around there. But now when you drive past, it looks like a tented homeless camp, very unattractive. It's not really a place you want to be in. And I think we're seeing semblances of that throughout the economy in terms of the deterioration that you can see right in front of you. So while the yield that you're getting on bonds is interesting, you have to contextualize that in terms of the fundamentals. So in 2007, I mentioned yields moved above the 10% level, but what did South Africa look like in 2007? Our total debt was 570 billion rand. That total debt, we spend more than that just on the wage bill. Our total debt now is 4.7 trillion rand. At the same time, our GDP has increased substantially. That happens even though we haven't had real economic growth. We have had inflation since 2007. Our debt to GDP has increased from 30% to 71%, so a very big increase, and it would have been worse if we hadn't rebased our GDP. And at the same time, the government is extracting more of the resources of the country in terms of tax. The marginal rate has gone up from 40 to 45%. Dividend tax has gone up from 10 to 20%. So the government is extracting a lot of money and it's spending a lot more. And we have a limited ability to grow because we can't generate enough electricity. The energy availability factor in 2007 was 88%. It's now hovering around the 50%. Hence, we're sitting with stage 5 and 6 load shedding on a very consistent basis. Now, I've painted a very cautionary and a very difficult scenario for South Africa in terms of the debt trajectory and what we've built up. And Farzana will talk about what that means for South Africa and what are the scenarios in terms of resolving this very difficult situation.
Yeah, thank you, Rashaad. Okay, so Rashaad's painted a very bleak picture of the significant debt burden that we're facing in South Africa, and I will take you through how far away is South Africa from a debt crisis, what are the market implications on countries who implode following a debt crisis, and then how best to structure a fixed income portfolio that will protect capital in this riskier environment. So, over the past year, we've seen a number of countries default, and we expect this trend to continue. And the reason for this is many countries borrowed excessively during the period of ultra-low interest rates, and now with interest rates having risen, their debt service costs have gone up and they're struggling to meet interest payments. In fact, in Africa alone, debt service costs have tripled over the past decade. And according to the IMF, in 2015, 8 out of 50 countries in Africa were in debt distress. But if you move forward to 2023, that number's gone up to 23. So 23 out of 50 countries, that's almost half of African countries, are in debt distress. South Africa is not yet on that list, but it's very likely that we end up on that list. And, the IMF also tracks 73 indebted nations, of which 40 are in debt distress. And that means that these countries are either busy restructuring their debt or they've missed an interest payment. So, it just shows you that the number of fragile and indebted countries is definitely on the rise, and we are moving to a higher risk paradigm. Here we're looking at the riskiness of South Africa relative to other countries from a sovereign debt vulnerability point of view, where you're looking at things like debt to GDP, country risk premium, and the countries on the top of this list are most at risk. South Africa ranks number 15, so we're sort of middle of the pack. So we're not falling over tomorrow, but we certainly have risk. And in fact, if we had not rebased our GDP, if we had not run with a higher level of inflation, we most likely would have been in that top 10. And if you look at countries in the top 10, most of them have already defaulted, and includes names like Ghana, Pakistan, Argentina, Ukraine, etc. And at number 15, we're middle of the pack. But at the same time, we rank worse than countries like Nigeria, Morocco, and Turkey, who are all in very precarious positions. Morocco just recently went to the IMF for a $5 billion credit facility. So, the number of fragile and indebted countries is on the rise. And also, a debt crisis for South Africa is not something that is in the distant future. It's actually something that we could face in the near term, in the next couple of years. So, what we thought is we'd compare the debt metrics of South Africa versus two countries that have defaulted, which is Ghana and Pakistan. So first we looked at debt to GDP. So that tells you how indebted a country is. And if you look at Ghana, they're at 87%, Pakistan at 71%, and South Africa is at 70%, not too far off from Pakistan. And in fact, that number is expected to go up to 73% post the Eskom bailout. And also, given the rising risks that we're seeing around SOEs and municipalities, we just expect that those debt levels to continue rising. If you look at interest, how much we're spending on interest costs relative to GDP, Ghana was sitting at 7%, Pakistan 4.9%, and South Africa 4.3%. But bear in mind that, our debt service costs have actually doubled over the past decade, and we certainly look like we're on an upward trajectory. And then lastly, if you look at growth, Ghana is sitting at 2.8, Pakistan 3.5, and South Africa, the worst of the pack, we're sitting at 1.1%. As Rashaad mentioned, over the past decade, we've been at 1%. We really haven't had any growth. The IMF and the SARB came out with very, very bleak growth forecast for South Africa. For 2023, they're expecting numbers of 0.2, 0.1, which is close to zero. The next couple of years, they're looking at around 1%. So, South Africa sitting with a very fragile debt situation, very fragile debt metrics. And at the same time, we don't have growth. And growth is one lever that can actually help pull us out of a debt crisis. So you may wonder, what happens in a debt crisis? So when a country is fragile and there's a shift in investor sentiment, and that shift could be on the back of anything like a flood, power outages, etc., then what would happen is you would have a sell-off in the bond market. What then happens is your bond prices fall and your bond yields rise. Debt service costs go up. You have a sharp weakening in the currency. You have an upward spiral in inflation, and then you end up in this vicious cycle. We can see this in the case of two countries that, how it played out in the case of both Ghana and Pakistan in their recent debt crisis. So, Pakistan was highly indebted, and the trigger event for them was the floods that we saw late last year. Ghana was highly indebted. There was no real trigger event. But the market just realized that they wouldn't get paid back their debt. And here in these charts, we're showing you the bond prices of both these countries and how they reacted in the debt crisis. So, for a long time, both of these countries had very weak fundamentals, but their bond markets were fairly stable. In fact, at the beginning of 2022, both of their bonds were trading close to par, which is around 100. And within a space of 12 months, it had fallen from 100 all the way down to 40 cents. That's a 60% drop in value over a very short space of time. So this just highlights that when a country has fragile fundamentals, such as your Pakistan, your Ghana, and South Africa is also in that mix, the bond market can remain stable for a very long time until you hit that trigger event. And when you hit that trigger event, that deterioration can be very rapid. And we can see what happened to the currencies of these two countries. So both of their currencies weakened over 100%, with Ghana weakening 150% and Pakistan 120%. This then has massive implications for inflation. And both of these countries, the inflation went from 8 to 10% to 30 to 50%. That's a massive move. So you may wonder, how does one go about resolving a debt crisis? So there's two options depending on the nature of the debt. If a country is sitting mainly with offshore debt, like Pakistan, for example, then that means they can't print foreign currency to pay off their debt, and they would have to go the route of either restructuring the debt, which means they could extend the term, they could amend the coupon, or they would have to impose a haircut, which means they pay investors back less than what they borrowed. If a country is sitting with local debt, such as South Africa, such as Ghana, then the path of least resistance is actually to inflate, to run with a higher level of inflation. And what we mean by that is if a country can't pay off its debt, they can print money. When you've got excess money in the system, it creates inflation. When you've got inflation, your GDP of your country goes up. And if you look at your debt to GDP metric, when your denominator goes higher, your debt to GDP actually falls lower. So a higher inflation can actually help reduce the debt burden in a country and help a country get out of its debt crisis. This is a very negative scenario that we're facing in South Africa. It's very likely that we are going to end up running with a higher inflation in order to get out of our debt crisis. So, what is the solution and how should we invest in this environment? So, in our Flex Income Fund, these are the assets that we're seeing value in at the moment. So in this higher risk environment, we expect interest rates to go up, and the asset class that will do well with rising interest rates is floating rate notes. We expect inflation to go up, and the asset class that will go up with rising inflation is inflation-linked bonds. We expect the currency to weaken, and the asset class that gives you protection against any currency weakness is offshore assets. And we expect equities to go up, and the asset class that can be held in fixed income portfolios that will give you exposure to equities is convertible bonds. Here we're just showing the current yields that you can earn in the fixed income environment at the moment. And you can see that government bonds are offering you a yield of over 10%, which is a decent yield if rates stay flat. Inflation-linked bonds in the current environment are also offering you yields of over 10%. And money market is not too far off, giving you yields of over 9%, but with a much lower level of risk. So remember that about a year ago, your money market yields were about 3 to 4%, but with repo having gone up significantly over the past year, it's now catching up with bond yields. And then this shows the return profile of the same list of assets, but in a higher inflationary environment. So if we assume we move to an environment where we run with a structurally higher inflation of, say, perhaps 9%, and that is the average inflation that we had pre-2000. If we assume short rates move to 10%, if you look at pre-2011, pre-2008, we ran with an average short rate of 11%. If we assume bond yields move up another 3% from 10.5 to 13.5, and maybe another 20% depreciation in the currency, then this is what the picture looks like. So we don't think this is a very adverse scenario that we're painting in light of what we've seen with what happened to inflation and currencies, etc., in Ghana and Pakistan. And in this environment, you can see that government bonds, that nominal bonds will actually give you a negative return, while all the other asset classes will give you a return of over 10%. So, it's government bonds are actually the riskiest asset class in this environment and the asset class you want to avoid. So how are we positioned in the Flex Income Fund going into this more risky environment? We hold a blend of the 4 assets that we believe will offer you a decent return and protect capital in this risky environment. The fund is yielding a very attractive yield at the moment of over 9.5% with a very low level of downside risk. So, we hold a lot of short-dated assets, which means we're not sitting with a lot of interest rate risk in the fund. We also hold very good quality assets. We're holding predominantly senior bank paper, government paper, very little corporate paper. So we're not taking a lot of credit risk to get to the yield that we're getting to. And also, we don't have a lot of AT1 and sub-debt, in light of the risk that we're seeing in the sector from what we've seen in the recent global banking crisis. So to sum up, in every fact sheet you read the phrase, past performance is not indicative of future performance. And the same holds true for bonds now. In 2007, it was a no-brainer to buy bonds at yields above 10%, and they would have delivered a good return. But that is not the case now, as South Africa is a lot more fragile now than we were in 2007. And in this risky environment, we have a preference for assets that will protect capital, and bonds at these levels will not protect capital. In the Foord Flex Income Fund, we're holding a blend of assets that we believe will protect capital going into this risky environment that we painted, while at the same time offering you the returns you are looking for your investors.
Thanks, Farzana and Rashaad. We do have a few questions which have come through. Thanks to those of you who've also submitted questions in advance. I'm going to start first with a few of the macroeconomic questions that have come through. Rashaad, this is obviously quite a bleak picture of deterioration. Of course, we always live in hope of things turning around. What do you think could cause the trajectory to actually change?
So I think we've both talked about the severe debt situation, and Farzana talked about how you get out of it. And effectively, a lot of economies, countries, they have the option of either inflate their way out of it, or they could grow their way out of it. Now, in order to grow your way out of it, we need to see a lot more positive economic policy and direction coming through from the government. And while over the last few years, we've had a lot of plans and strategies and policies in place, unfortunately, I don't think there's a reflection from the ANC and the government that the private sector is the one that needs to be delivering growth, and we need policies which improve confidence and entice the private sector to invest in a much bigger way.
Okay, so that sort of brings me to the next question. We have recently heard the president talking about the fact that we may need to re-examine the decommissioning and mothballing of coal-fired power stations temporarily, given the energy crisis that we have on our hands. But that could compromise the $8.5 billion Just Energy Transition Partnership. And of course, that was what was concluded in 2021, a deal with France, Germany, the UK, the US, and the European Union. And of course, that would be going towards generating this renewable energy capacity. Which do you think we need to prioritize at the moment? Sort of solving the energy crisis with what we have at our disposal, or actually investing in these alternative energy sources?
I think when you're sitting at stage 5 and 6, the answer is quite obvious. We do need to ensure that electricity generation does come through as the first priority. And longer term, you need to plan for a more renewable energy mix, but that is a lot more difficult than a lot of people think. It needs a lot of planning, a lot of preparation, a lot of investments. And these countries that you've mentioned that are funding our renewable just energy transformation are the ones who are reopening their coal plants. So it's a bit absurd that they're basically lending us money in order to close our coal plants, while they are reopening theirs. So I think one of the positives we've seen recently, and I was at the president's Economic Investment Conference in Johannesburg 2 weeks ago. And a lot of it is spin and fanfare, which maybe we need a little bit of positivity here in South Africa. So that is justified. But one of the more positive developments was listening to the president's speech. And he spent more than half his speech just talking about the need to get electricity back on. And I think you've finally seen, after many years of electricity not being prioritized, it's finally hit the ANC that if only for the electoral prospects, they need to get this right in order to maintain their own power in going forward.
And yes, I think possibly the developments over the last year have led many countries to reassess how rapidly they can make that transition from fossil fuel energy into alternative sources. So perhaps everyone is sort of more on the page as far as that goes, and there'll be some sort of understanding with regards to that.
The new energy minister has come out, Minister of Electricity, which we found quite funny at the time. But I think the initial efforts by him have actually been quite positive. He's come out very strongly to say we can't just continue with this plan of closing power plants while the lights are off. We need to get them working properly, and the longer term we will sort that out in due course.
So Farzana, we've got a question that's come through from Alison, just to clarify whether we do have any SOE debt in our fixed income funds, and I think we can answer that for the multi-asset funds as well. But in principle, one listening to the presentation today might get the impression, given sort of the deteriorating outlook and all the risks that we've highlighted, that we would never invest in nominal government bonds. And I think the important thing to get through is that it's not that we wouldn't invest in government bonds, it's just that we would like to be adequately paid for the risk that we're taking. And of course, Rashaad has highlighted that risk has increased. So I guess the obvious question is, what price would we'd be interested in buying nominal government bonds in our fixed income portfolios? And is there a price at which we would be prepared to buy SOE debt as well?
Okay, that's a very good question, Linda, and we should address that. So, Foord is a valuations-based house, and everything comes down to the price. And, with bonds, we also have a fair value model, and that sort of guides our investment decisions. And when we look at fair value of bonds, there's certain inputs that go into that. The inputs are US real rate, South African inflation, and country risk premium. And when it comes to looking at South African country risk, we don't just use the CDS as a proxy. Rather, we come up with our own assessment of what we think the forward-looking risk is for South Africa. And in order to do that, the things we take into consideration is the forward-looking growth trajectory for South Africa, the political risks that we are going into, the fiscal risks, the debt metrics, and given where we are and what we're seeing in the forward-looking environment for South Africa, we are using a much higher risk premium than what is in the CDS, and our fair value is basically coming up to where the bonds are at the moment. So basically, bonds are at fair value at the moment. They're not cheap. They're not a screaming buy, given the risks that we are seeing. But, at 1 or 2% above fair value, at those sort of levels, we will start buying bonds and we will buy into that weakness. But for us, our primary objective is to protect capital. And, we believe the best opportunities materialize when those blow-ups occur. And when those blow-ups occur, and we do see them last year, bonds got to close to 12% 3 times. So we would like to protect capital going into the blow-up. And then in that blow-up, we would have enough ammo to buy then into that weakness. And then finally, I'd just like to say that, we don't feel like we're missing out too much at the moment by not having bonds. We do have exposure to lower risk assets that are giving you yields close to bond yields, such as money market, inflation-linked bonds, which are sitting well above 9% at the moment. So, we're very comfortable with the position at the moment. We think we're well positioned for any sort of risk-off event in the market. And then lastly, just to touch on SOE exposure. So, the fund at the moment, from a credit quality point of view, is very conservatively positioned. More than 80% of the fund is in senior Big Four bank paper and corporate paper. We have no AT1 sub-debt exposure and no SOE exposure. We've been a bit cautious on SOE since the land bank default. And also since the land bank default, there hasn't been many SOEs coming to market. That market's been sort of dead. It's really been a struggle. Names like Transnet, etc., have really struggled to fund in the local market. The only name that we have seen come to the market is DBSA. And that too, at spreads that, we don't think are attractive enough given the risk that we see in that sector.
Okay, so just to give a range with your yields, at what sort of yield level would you be interested in the nominal government bonds? Did you say 12%, around that, heading towards that range?
So fair value is at 11%. So 1 to 2% above fair value will take you to 12, 13%. So from about 12%, we would start buying into it, and we would buy into weakness as the bonds weaken further.
Right, okay. And just for those of you who are less familiar with fixed income terminology, when Farzana talks about the spread, she's talking about the additional yield that you would be paid for lending money to, of course, these institutions. So you'd want to be earning quite a bit of additional yield over sort of your normal sort of US Treasury, for instance. So let's talk about inflation. Kevin asked, what is the impact of inflation on markets? I think let's speak specifically to fixed income. You spoke about the fact that we do have some inflation-linked bonds in the portfolio, which are generating some good yields. What are some of the benefits of having inflation-linked bonds versus nominal government bonds? Farzana, if you could also address that, and then we'll move to Rashaad for some macroeconomic content.
So, when you're holding Rand bonds in a fund, you're not so much worried about default risk because the government can always print money. So I think when it comes to bonds, we're not so concerned that we're not going to get paid back our money. We're more concerned about how much more the price can fall. So, to get out of a debt crisis, if we move to a higher inflationary environment, the only asset class that will offer you full inflation protection is actually inflation-linked bonds. By design, they were created to give you full inflation protection, and how they work is the yield, the total return that you get on the bond is the inflation that prints plus the real yield that you locked in. So if, for example, we move into a structurally higher inflationary environment and say inflation averages 10%, you will earn 10% plus whatever real yield you locked into. And at the moment, we're locking into over 4%. So you will earn 14%, which is a very attractive yield, much more attractive than your nominal bonds. And in fact, in that higher inflationary environment, your nominal bonds will suffer the most because now those yields have to adjust higher to compensate you for that higher inflation. And that capital impact as the yield moves up can be quite significant.
Right, okay, so you're getting 4% yield over and above inflation with your inflation-linked bonds, irrespective of what inflation turns out to be. So let's talk a little bit about inflation, Rashaad. One of the big factors that go into sort of causing inflation to surprise on the upside, recently we saw that happened again in South Africa, is the Rand depreciation and how that feeds through into the elements of inflation. We have had some questions, particularly from John, asking about the range for the Rand. Is the Rand oversold, do you think, at this current level, and will it continue to weaken?
So just on inflation, we know it's moderating in the short to medium term, and we'd likely fall within the target band in Q3, Q4 this year. At the same time, global inflation, like US inflation, has fallen from 8 down to about 5%. So we're seeing a general moderation, but our view is that we're not going back to the old targets. So in South Africa, we're not going back to 4.5%. In the US, we're not going back to 2%, and we're likely to remain sticky above those type of levels. And that's why, as Farzana mentioned, we're liking the inflation-linked bonds. So in terms of the Rand, we have seen quite a significant depreciation. Even this year, the Rand's underperformed the majority of emerging markets and commodity countries. And it does feel like global sentiment has shifted take quite a negative stance on South Africa. So if you look at the FT and Bloomberg, I think the lack of growth, the lack of the ability to supply electricity, if you look at the last decade, we've talked about this 1% economic growth, but our population has grown by more than 1%. So our GDP per capita, which is actually the true measure of where you are as a country, is gone backwards. We minus 5% over the last decade. So I think there's a reflection that unless something changes, South Africa is continuing to move backwards. And while the rand is still overstretched, if our fundamentals don't readjust, then unfortunately the currency will have to continue to compensate for those poor fundamentals and continue to see a deteriorating trend.
So we obviously have to factor that into how we manage our multi-asset portfolios as well, in terms of having some rand hedge exposure, I know. And of course, in the Flex Income Fund, we are able to buy some offshore assets. So that helps. And that was one of the assets that you actually highlighted, Farzana, offshore assets, which are one of the opportunities. Looking at some of the instruments which are related to more current interest rates, such as floating rate notes and NCDs, could you just speak to where we think interest rates are going in South Africa? And I know that we obviously have been liking sort of those instruments which are related to those near-term interest rates. And perhaps, Farzana, you can just speak about some of the instruments that we've brought into the fund recently off the back of rising interest rates locally.
Okay, so at the moment the market's discounting another 50 basis points worth of interest rate hikes in South Africa. So with repo sitting at 7.75% at the moment, that means prime is sitting at 11.25% at the moment. We're at quite extreme levels given the growth outlook in South Africa. At these levels of growth, it's hard to see interest rates going much higher than that. So we do think 50 basis points is quite extreme. They do tend to follow the US. The US is pricing in one more 25 bp hike now in May. But we think that the market is pretty fully discounted at the moment. So we thought if with the market pricing in 50 bips, we can actually lock in that rate. So the money market curve, so your 1-year rates are sitting at about 9.25% at the moment. So you can buy a 1-year bank NCD, which is senior paper, very secure, and earn 9.25% because it's discounting this additional 50 bips worth of rate hike. So we've been buying that in the portfolio. You can also buy floating rate assets where you can earn JIBAR plus a certain pickup in the region of say 1%. At the moment, JIBAR is about 8%, so you will earn 1%, which gets you to 9. If JIBAR goes up another 25 or 50 bips to say 825, 850, that takes you to 925, 950, 9.5. But it's hard for us to see rates going much further than the 50 basis points.
Okay, so we sort of see we're in line sort of with the market view that there's probably a few more rate hikes down the line, but not much more to come thereafter. Rashaad, looking at the global situation, we have been asked a few questions about that. Annika asked, when do we expect interest rates to be lowered again, both in South Africa and internationally? Wally asks it a different way. He says, can we see sustained high interest rates into the new year? We've spoken a little bit about the South African situation. How quickly do you think the South African Reserve Bank would be able to cut rates? We're speaking about a few more rate hikes, but certainly in the US market, Fed futures are pricing in quite dramatic rate cuts, and we've seen the US yield curve is quite dramatically inverted, which means that there's also expectations of rate cuts from that perspective. Do we agree with that, and what do we think that's predicated on?
Yeah, as Farzana said, it feels like while there is a little bit more to come, the bulk of the rate hikes have already come through. So we've seen over the last year 0 to 5% in the US. That's a very dramatic increase in rates, the sharpest rate increases since the 1970s. So from this point onwards, the question is, how long can they keep rates at this level without the economy falling over? So you've already seen the effect of high rates on portions of the economy. The US economy, the US housing market, for example, has been in a bit of a stall mode because mortgage rates went up from 3% to 7%. It's very difficult for someone to afford a new house when the mortgage rate is 7% compared to where it's been. And in the last month, you've effectively seen the US banking system come under severe pressure. There's a banking crisis at the moment. It's the sharp period where SVB was forced into liquidation. That sharp period is over, but the banks are continuing to bleed. There is the argument that the banking system in the US cannot sustain this level of rates because they've been locked into these low rates. They're not earning enough, and they're having to pay depositors a lot more. So I think while the market expects the Fed to come through with rate cuts by the end of the year, I think the Fed is doing as much as it can in order to maintain rate at these levels in order to fight inflation. I think the US economy is in a very vulnerable position, and they do need some release in terms of interest rates over the next 6 to 12 months.
Yes, and I mean, we've seen obviously those sort of flows out of deposits into money market funds. And we've spoken quite a lot internally about new entrants into the market, such as Apple, who obviously don't have a book where they're lending at 3%. So they're able to actually pay much better yields. So your view is that could cause various sort of more issues in the US banking system?
Yeah, I think the situation is more precarious than people realize. And I was actually surprised when the news came out that Apple launched that deposit facility, because the banks are bleeding deposits heavily. And bank runs nowadays happen on a much more accelerated scale. And Apple doesn't have these legacy issues of all these loans they've written. They can come in, pay 4.25%, and immediately earn 5% on T-bills. So that's effectively free money for them. They're taking that opportunity, but what they're going to do is they're going to accelerate that deposit growth, that deposit outflow, and put the banks under even more pressure.
Okay, and then we've had a few questions, I think quite a topical issue. And to those who've asked about this, and namely Timothy and Ryan, we are going to be having a separate discussion on this. So keep your eyes open for a conversation between Rashaad, Nick Balkan, and myself on this topic. But just to touch on it very briefly, Timothy, you asked, what is Foord doing to counter the possibility of a fall of the petrodollar and the implications thereof? And I suppose the petrodollar is one element as to why the US has been sort of the global reserve currency. But also Ryan asking about this proposed BRICS currency and the potential risk for South African investors. So let's just get your view on how likely it is that we are going to be moving away from the US dollar being the dominant currency for global trade and finance.
I think we're still a long way from that. Yes, there's a lot more talk, but people have been talking about the decline of the dollar for a long time. This time, I think it is more serious. There's a concerted effort from China, who's the main economic challenger to the US, as well as other economies like Russia, Brazil, effectively the BRICS, in order to release themselves from this control of the dollar system. The question is, what's the alternative and what can they do about it? To date, the proposals, including that BRICS currency, are very vague. It almost feels like they're just making a statement that they want to be out of the dollar system, but they don't actually know how to go about doing it. So for now, we don't see that as a near-term risk.
But I think it's also probably worth mentioning that we do hold some gold in our positions as well. So it's done very well for the portfolios latterly, but that is a bit of a sort of insurance policy, I guess, against the US dollar falling out of favor. Well, unfortunately, those are all the questions that we have time for today. But we will get back to any of you who have submitted questions online with an answer. So we do commit to doing that. Just to summarize what we've spoken about today, Rashaad spoke about how historically there have been periods of time where when you've invested in South African government bonds and yields have been above 10%, you've actually had a very attractive return during the subsequent period thereafter. However, he did outline that that's very dependent on the backdrop. So if you looked at periods of time where there was high inflation as a backdrop, which is not completely sort of unrealistic to consider, given that the South African government does have a debt problem that they might like to inflate away. So from 1960 to 2000, when inflation was over 9%, the range of returns that you got investing in government bonds when yields were above 10% was far wider and far less attractive on the lower end of that range. And we looked at various metrics, compared also obviously the fundamentals of South Africa to other African countries, such as Ghana and other areas of the world, such as Pakistan, where they have gotten into difficulty. So highlighting, I guess, that the risk of lending money to the government has increased, and that there is at this stage, not a lot of promise that that is going to turn around anytime soon, especially with municipalities continuing to take strain and the likelihood of further SOE bailouts as well. We also highlighted that unfortunately real GDP has disappointed in South Africa over the last few years, and that our debt servicing costs are now sitting at about 20% of revenue. So those are headwinds with regards to the quality of government bonds improving in terms of the risk that you're taking to lend to them, and that we would like to see higher yields compensating us for taking on that additional risk. And we certainly do have dry powder to put to use when those opportunities do come about. But Farzana also showed that there are other attractive opportunities within the fixed income spectrum, which we are taking advantage of, that our yields in our funds are very attractive, and therefore our funds do offer a really good alternative to perhaps other exposure, which is higher with regards to credit risk, which are perhaps already full up on nominal government bonds, where we can actually take advantage of any opportunities that come along for us to buy those nominal government bonds at yields which we think more accurately price the risk involved. And we summarize by saying that we really feel that our funds are positioned well, not only to obviously protect against inflation, but also to protect in our, for instance, Flex Income Fund against some depreciation of the rand, and that we do believe that there are opportunities in the fixed income space, particularly with rising interest rates as well on the short end of the curve. Thank you, Farzana and Rashaad, for joining me today, and thank you to everyone who has joined us. Take care.